Good day everyone, this is your European Open briefing for Tuesday, August 2nd. My name is Michael Florentiades. I am the Chief Economist here at xm.com, and these are the key developments this morning. The Reserve Bank of Australia cut interest rates by 25 basis points to 1.5%. The Aussie, however, was unaffected by this move. The yen is looking strong as it awaits the Prime Minister Abe's stimulus package approval. Oil dipped below $40 overnight but clawed its way back above this threshold, and in the calendar today we are expecting UK construction PMI and US personal income and spending. The RBA, as you can see, it has been lowering interest rates for the past 5 years. It cut its rate by 0.25% to 1.5%. This is a record low, the lowest interest rate ever for the Australian economy. What did the RBA cite as rationale behind its move? The global economy is relatively weak. Inflation is low. Part of the global economy, is also the Chinese economy, as growth is moderating there. The real estate market is not as hot as to create fears of excesses and bubbles. The exchange rate is relatively strong, and despite the commodity prices rebound that we have seen this year, prices are still low. So these are reasons behind the cut. The Aussie, however, was resilient, as you can see, in the face of the cut. This was when the cut was announced. It dipped to 75 cents, to around 75 cents immediately following the announcement, but it rebounded to around 75.50. And there is a case of US dollar weakness as well this morning, as the euro has also broken above 112, which is a 5-week high and the highest post-Brexit for euro dollar. The dollar yen broke below 102, and sterling rose up to 132.30, although sterling gave up those particular gains. The yen crosses have been unimpressed by the Bank of Japan announcement on Friday and the prospect of Abe's fiscal stimulus. The yen has also brushed off Minister of Finance Taro Aso's comment on extremely nervous moves in foreign exchange markets. It's waiting for the market is waiting for stimulus approval by the cabinet, and it's expected that the Japan's cabinet is going to approve 7.5 trillion yen in real spending plus 6 trillion yen in loans. Also, the dollar is on the ropes after a dovish Fed on previous Wednesday, low GDP growth on Friday, and the manufacturing ISM announced yesterday was a little worse than expected. On to oil. We have seen oil dipping below $40 a barrel, but oil managed to claw back above that level. Oil definitely had a bad Monday, around notching losses of around 4%. This was in the absence of any inventory releases, etc. But there have been worries about the oil glut, that the market is continuing to be oversupplied, that there is not enough demand for oil, despite this being the US driving season. And the interesting part is that risk assets were not as moved by the drop in oil, unlike previous episodes of oil weakness earlier in the year, which did hurt equities a lot. So petrocurrencies, of course, were hit. We're talking about currencies like the Canadian dollar, the ruble, the Russian ruble, Norwegian krona. Those are more connected with oil. And it's interesting to ask if the relationship between risk risk assets and oil prices is going to reestablish itself. At what point, if we see some more volatile moves in oil and some further drops, maybe it would scare off some investors from risk assets. So we'll have to see, but no sign of that just yet. It's just something to watch. On to today's data calendar, we had pretty bad building approvals out of Australia. We were expecting a 0.5% increase. Instead, we got a minus 2.9% decrease. We also had a worse than expected trade balance. Instead of 2 billion, 3.19 billion trade deficit. And of course, the RBA rate cut as expected. Most economists were expecting a rate cut, and it did take place. And now we are focusing on construction PMI in the UK. This is going to drop to around 43.8 from 46. And later during the US session, we have US personal income and spending, which is they are expected to rise by 0.3%. And of course, we'll have to look at core personal consumption expenditure price index and the headline PCE price index. So the headline is at 0.9%. The core, which is something that the Federal Reserve really pays attention to, 1.6%. So we will be watching those indicators very closely, as they are the ones, as we've said, that the Fed is focusing on. Finally, just a note to say that maybe these are the dog days of August. August is supposed to be one of the most quiet months in markets, with a lot of traders on holiday, but the market itself has certainly not exactly been quiet the first couple of days of August, so this is something to keep an eye on. Thank you very much for watching, and have a great day.